The data you cited from March 5th, all those microstructure 2026, CEO Ryan sales.
Well, rather than suppressing a surge in day's total trading activity. Almost half the shareholders received one warrant, trade massive, and the projections for Q.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
If we look closely at the trade reporting data from March 5th, 2026, the execution metrics paint a highly unusual picture of market mechanics. We saw total off-exchange volume hit exactly 588,966 shares.
Which, just to put that in perspective for anyone tracking the tape today, represents precisely 49.02% of the day's total trading activity. Almost half the volume didn't even hit a public lit exchange.
Exactly, almost half. And the equity is consolidating heavily near that $24.00 support level. Yet we are staring at an elevated 30-day implied volatility, which is essentially the options market's forecast of how wild the price swings will be. That's sitting at roughly 55.9%. And on top of that, we have a high short volume ratio tracking consistently between 44.8% and 49.5% for this entire first week of March.
Meaning nearly half of all trades being reported are marked as short sales. It's a fascinating, honestly almost paradoxical setup.
It really is. And this anomalous microstructure, it forces us to confront the central questions surrounding GameStop in early 2026. Does this unprecedented market environment, combined with the company's multi-billion-dollar cash reserve, reflect a brilliant fundamental transformation into a modern holding company and digital asset hub?
Or does this high-beta, highly volatile, speculative trading activity merely mask a dying retail business? One that is, attempting to survive strictly through financial engineering rather than actually selling products.
Well, I will be making the case that GameStop is executing an absolute masterclass in capital allocation. They are successfully using their zero-interest cash reserves, their newly established Bitcoin treasury, and unmatched insider alignment to build a resilient holding company that is completely immune to traditional retail headwinds.
And I come at it from a very different way. I will argue that the core business is in severe decline, and the stock's valuation is a total anomaly. It's propped up entirely by options market mechanics, crypto volatility, and speculative retail sentiment, rather than tangible enterprise value.
The data you cited from March 5th, all those microstructure anomalies, that's exactly why we need to view this through a different lens.
But we have to separate the underlying enterprise from the trading vehicle. When we look at this situation, we absolutely have to ground ourselves in the operational reality before getting swept up in this grand holding company narrative.
I see why you think that the core retail business is the focus. I really do. But let me give you a different perspective. Let's look at that operational reality, but from the perspective of the balance sheet, because that is where the true transformation has occurred over the last year. In the first half of 2025, GameStop leveraged its market valuation to raise massive liquidity through two primary offerings of convertible senior notes.
Which is debt that can later be converted into company stock.
Right. In late March 2025, they secured $1.3 billion, followed by an upsized offering in June of $2.25 billion. But here is the crucial detail. These were 0.00% convertible senior notes due in 2030 and 2032.
Meaning they pay zero interest to the bondholders.
Exactly. 0%. They secured billions in cash without incurring any traditional debt service costs. That gives them unparalleled dry powder. They can sit on this capital without the clock ticking on interest payments. Furthermore, look at the unmatched alignment between leadership and the shareholders. In January 2026, CEO Ryan Cohen went to the open market and purchased 1 million shares.
Spending over $21 million of his personal funds.
Yes, at an average price in the low $21 range. Couple that with his 100% performance-based compensation. He takes no salary, no stock awards unless massive market cap targets are hit. This is a unique Buffett-style playbook. Think of early Berkshire Hathaway. Warren Buffett didn't keep pouring capital into his failing textile mills. He used the cash flow to buy insurance companies. GameStop is attempting that exact pivot, but traditional analysts are fundamentally misinterpreting it because they are obsessing over physical store sales instead of looking at the balance sheet.
Look, I'm sorry, but I just don't buy that. And let me tell you why. You can have all the zero interest dry powder in the world, but it does not change the severe deterioration of the core operations. We have to look at the stark reality of the full year 2025 revenue. The physical game market is shrinking. Yes, we know that. It's not just shrinking. We witnessed a 27.5% plunge. They dropped top-line revenue from $5.27 billion in 2024 down to $3.82 billion. That is massive. And the projections for Q4 are pointing toward a return to negative earnings, specifically an earnings per share or EPS of -8 cents. That is not a seasonal dip. That is a structural collapse of the physical software and hardware markets.
But again, you're evaluating them as a legacy retailer, not a holding company.
Because they still operate thousands of retail stores. And furthermore, the March 2025 pivot to a Bitcoin treasury reserve, I see that as a highly dangerous distraction. Yes, in theory, it might hedge against currency devaluation, but in practice, it essentially turns the equity into a crypto proxy. We have seen the outsized impacts of crypto price corrections on equities like MicroStrategy. Adopting Bitcoin adds immense beta, meaning the stock's price swings become violently tied to the crypto market, but it absolutely does not fix the secular headwinds in gaming retail. I have profound skepticism about the holding company narrative when you have to justify a valuation that has become completely disconnected from operational earnings.
I appreciate the focus on traditional revenue models. I do. But we have to acknowledge that traditional valuation models simply do not account for the illiquidity foundation provided by this specific shareholder base. It's unprecedented in modern markets. Let's discuss the direct registration system, or DRS.
Ah, the retail lockup.
Exactly. As of the third quarter of fiscal 2025, retail investors were holding 66.7 million shares directly at the transfer agent, Computershare.
Which is roughly 15% of the outstanding float.
Over 15%. And for our listeners, when retail investors register shares in their own name through DRS, they remove those shares from the lendable float used by prime brokers and short sellers. Retail has essentially created a baseline of illiquidity that protects the stock from being shorted into oblivion. And it is not just retail holding the line anymore. We are seeing major active funds taking long positions alongside them in early 2026.
You're referring to the recent 13F filings.
Yes, Jane Street Group added over 2 million shares. Pacer Advisors added 1.1 million shares, which increased their position by over 19%. Philosophy Capital Management just established a brand new position of 950,000 shares. The whole narrative of institutional flight is a myth. Smart money is accumulating.
That's a compelling argument, but have you considered the complete disappearance of the institutional warrants?
You mean the special dividend from last year?
Right. Let's walk through that. When GameStop implemented the 11-for-10 forward stock split in October 2025, it was accompanied by a special warrant dividend. Shareholders received one warrant, trading under the ticker GMEWS, for every 10 shares they held. A warrant just gives the holder the right to buy stock at a certain price in the future. Now, initially, 130 institutional owners held over 2.2 million of these warrants.
Right, that was right after the issuance.
Exactly. But if you look at the 130F filings processed through mid-February 2026, reporting institutional ownership of those warrants fell to absolute zero.
Zero.
Zero. Institutions are entirely divesting the long-term upside to retail. They are not holding for a 5-year holding company transformation. They dump the warrants. And even your DRS numbers, while holding 15% of the flow is impressive in a vacuum, those numbers have slipped. They peaked at 76 million shares back in early 2023. We are now down to 66.7 million. The retail flow is slowly eroding, and the institutions are explicitly declining to hold the derivative upside.
That's an interesting point, though. I would definitely frame it differently. The divestment of the warrants by large reporting institutions doesn't necessarily mean an abandonment of the thesis. Very often, large funds have strict mandate restrictions regarding the holding of speculative, unlisted derivatives. They might be required by their own compliance departments to sell them immediately.
Perhaps, but it still removes them from participating in that specific upside mechanism.
True, but if we are discussing derivatives and market mechanics, we absolutely must address the sheer weight of the options market and the off-exchange trading activity. Earlier, you characterized this equity as a speculative toy governed by dark pools.
Because the data explicitly shows that the stock's price is dictated by derivatives and internalizers, not by its fundamentals. Let's look at the options chains as of early March 2026. Everything revolves around the max pain price.
The strike price where the largest number of options contracts expire worthless.
Right. The price point where retail option buyers lose the most money and the market makers, the option sellers, keep the most premium. Right now, that max pain price is clustered heavily between $21 and $23.50. And simultaneously, we are seeing a remarkably low volume put-call ratio of 0.11.
Meaning for every one put option betting the stock will go down, there are roughly 9 call options betting it will go up.
Exactly. It is incredibly skewed. And because of that skew, the stock is trapped. It's caught in a gravitational pull managed by wholesalers, firms like Citadel Securities and Virtu Financial.
The internalizers.
Yes. For those unfamiliar, these firms utilize their own internal liquidity pools to match retail orders before they ever reach a lit public exchange. They manage their risk precisely through this options chain. When you have a stock where half of the daily volume is executed in dark venues and the options chain is that skewed, the equity is no longer trading on the merits of its balance sheet. It is a derivative instrument managed for volatility capture.
I see the mechanics you're pointing to, but you cannot mention the dark pool activity without acknowledging the short volume ratio. Yes, we are seeing a 30-day average of 50.31% off-exchange volume. But during this first week of March, nearly 50% of the daily reported volume was marked as short sales.
Well, short volume doesn't always equal short interest.
No, it doesn't, but the sheer velocity of it is staggering. On March 2nd alone, out of 1.84 million shares traded, over 912,000 were short volume. That proves there is immense, artificial downward pressure being applied daily. It is not just neutral volatility capture by market makers, it is active suppression of price discovery, and that is exactly why the upcoming FINRA regulatory change is so critical.
You mean the TRF rule change?
Yes. On March 30, 2026, the Trade Reporting Facility, the TRF, which handles off-exchange trade reporting, its operating hours will be extended to begin at 4 a.m.
Instead of the usual 8 a.m.
Exactly. Currently, a massive amount of early morning institutional trading happens in the dark and isn't reported in real time. This new rule will force firms to report pre-market transactions immediately. This forces transparency onto early institutional trading. I argue this will finally allow true price discovery to reflect the company's massive cash position, which, let's remember, exceeds $3.5 billion.
Increased pre-market TRF reporting will certainly add transparency to the tape. No one is arguing against transparency, but assuming it will magically result in upward price discovery is quite a leap of faith.
Why wouldn't it, if the suppression is happening off-exchange in the early hours?
Because transparency might just as easily reveal that the institutional bid simply isn't there at these valuation multiples. The dark pools might be hiding a lack of interest rather than suppressing a surge of it, which really brings us to the future deployment of this capital and the specific mechanics of those October 2026 warrants we touched on earlier.
The October 2026 warrants are the exact mechanism that proves the long-term vision. Let's break down what those actually represent. Each of those 59 million warrants allows the holder to purchase one share of common stock at an exercise price of $32.00.
A price the stock hasn't sustained in quite some time.
True, but if the upcoming Q4 earnings or the ongoing appreciation of the Bitcoin treasury pushes the stock past that $32.00 threshold, it triggers another $1.9 billion in gross proceeds for the company when those warrants are exercised.
Assuming the holders exercise them.
If it crosses $32, it's financially optimal to do so. We are looking at a scenario where by late 2026, GameStop could be sitting on over $5 billion in cash and digital assets. That capital prepares them for a massive, transformative acquisition.
What kind of acquisition, though?
There is widespread speculation in institutional models right now about targets in the consumer cyclical or digital payment space.
Names like Nintendo or Western Union have been cited frequently in the research notes. With $5 billion in cash, they are perfectly positioned to pivot entirely away from the legacy brick-and-mortar constraints. They don't have to fix the retail stores, they can just buy a more profitable business model outright.
I'm sorry, but relying on a $32 warrant exercise by late 2026 is purely speculative hope. If you want to see what sophisticated money actually thinks about the company's future, don't look at retail speculation about buying Nintendo, look at the leaps.
The long-term equity anticipation securities, the long-dated options.
Yes. Specifically, look at the high-premium July 2026 $20 put options. Sellers right now are collecting a premium of approximately $3.15 per contract.
They're utilizing yield boost strategies.
Exactly. For the listeners, a yield boost strategy in this context means large funds are selling put options, essentially promising to buy the stock if it drops below $20, just to collect that juicy $3.15 premium today. Because the implied volatility is sitting at nearly 56%, those premiums are incredibly expensive. Sophisticated capital is just farming the stock's volatility.
But by selling those puts, they are showing they are fundamentally comfortable owning the stock at $20.
They're comfortable collecting a premium to potentially buy the stock at a discount, yes. But they are not betting on a $100 billion market cap turnaround. They are trading the math of the options chain, not the fundamentals of a mythical consumer cyclical acquisition. No amount of cash and no amount of Bitcoin reserves can permanently hide a 27.5% drop in core revenues. The core business has to generate cash.
Holding company transformation. Berkshire Hathaway. Again, going back to that model, Berkshire did not continue to focus solely on its failing textile mills. It used the capital to outgrow its original form. GameStop is using a highly capitalized balance sheet, secured at 0% interest, to outgrow the legacy retail business. The fact that the equity has recently reclaimed its 200-day moving average, with volume patterns suggesting controlled accumulation near that $24 mark, indicates that the broader market is beginning to price in this transition.
I hear the Berkshire comparison constantly, but it ignores a fundamental reality. Comparing GameStop's current operations to the genesis of Berkshire Hathaway ignores the fact that early Berkshire made acquisitions that immediately generated robust operational cash flow. Insurance float generates yield.
And Bitcoin appreciates.
But adding Bitcoin to the treasury does not generate operational cash flow. It just adds beta. It's a highly volatile asset sitting on the balance sheet, not a cash-producing subsidiary. And partnering with companies like Cineverse for customer rewards programs, that does not replace the lost revenue of physical console cycles. The equity remains a high-risk derivative play governed by internalizers, not a nascent Berkshire.
Well, while we clearly disagree on the trajectory of the core business, and certainly on the ultimate purpose of the derivatives market surrounding it, I think we must explicitly agree on one undeniable fact here. GameStop has completely transcended traditional fundamental analysis.
Oh, without a doubt.
It is operating as a financial anomaly. It has a distinctly unique market microstructure that simply does not exist anywhere else in the public markets right now.
I absolutely agree with that. When you have a theoretically dying, yet debt-free retailer sitting on billions in cash, holding a Bitcoin reserve with 15% of the float directly registered by its own retail investors and half the daily volume executing in dark pools,
It breaks the models.
it completely shatters them. Traditional discounted cash flow models are effectively useless here. It is a highly complex structural anomaly.
And we will soon see which forces ultimately dictate the valuation. The pivotal Q4 2025 earnings release is scheduled for March 24th, 2026.
That will show us the true operational cash burn or cash generation.
Right. And then the FINRA TRF rule change takes effect shortly after, on March 30th. These two events back-to-back will undoubtedly provide the ultimate test for the stock's trajectory and for the entire holding company thesis.
The data from late March will certainly separate the operational reality from the microstructure theories. We encourage everyone reviewing the material to examine the balance sheet, dig into those 13F filings, and watch the TRF reporting changes to draw their own conclusions.
There is certainly a lot more to explore as this plays out.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!